back to the Bitcoin Layer. I'm Nick Bhatia. Today we welcome Lance Lambert. He is the co-founder of Resi Club, an excellent real estate residential market newsletter. Lance, thanks for
Thank you
joining
for
us.
having me. Really appreciate it.
Lance, you say that the housing market is constrained. What do you mean by that, and what are you looking at
So
specifically?
the housing market that we're in right now is one that has passed through an overheating in prices in 2020 into 2022, where national prices went up around 44, 45%. That was immediately followed by a historic rate shock where we went from 2.5%, 3% mortgage rates to 4%, to 5%, to 6%, to a little over 7, briefly to 8% last fall. Now we're right around like 7.29% for the average 30-year fixed mortgage rate was the reading for today. And so that affordability hit has constrained the housing market, especially on the existing side of the market. And so what has occurred is there is a suppression in the amount of churn or turnover in the market, where somebody would go sell their home to go buy something else. And so that person, that it just doesn't make a lot of sense for them because the switching costs are so high at the moment, going from their 2-3% mortgage rate or 4 up to a 7% mortgage rate. That affordability hit for them, or the shock for the new monthly payment, is just too high. And so the resale side of the market is constrained. Now, what has also happened is a historic pullback in demand in the housing market. Now, you're probably asking, well, historic demand pullback, but home prices are still rising. And the reason is if demand pulls back and supply pulls back, that supply and demand curve moves, you can still have prices increase, right? Now, what has occurred is in some markets, the demand pullback is maybe less prominent, or the demand pullback is more than other markets. So, like in Austin, Texas, there was not only a pullback in buyer demand because of rates going so high, but there was also a decrease in the pandemic migration, right? People moving from California into Austin in 2020, 2021, into 2022. That has slowed down. And that run up in prices is all that California money poured into Austin, pushed their price growth much higher than the rest of the country. Austin prices actually went up around 65, 69% in 2 years. And so locals were more priced out by the price jump, right? And then once rates shot up like they did, there was a greater than average pullback in housing demand in Austin. And then when you factor in the fact they have new construction and the new construction supply going into the market, all of those factors came together to suppress demand more than supply in that market. And so prices actually have fallen some in Austin, around 15 to 20%. And so when I say constrained, it's a market where you have very pressurized affordability. It's moved up very quickly. It's actually at around the worst in about 4 decades. But the inventory side of the market has stayed fairly tight as well. And so there's that real tug of war between supply and demand at the moment. And so I consider it constrained because we are at very low levels of existing home transactions, is the core reason. Now, if you flip over to the new side of the market, the new home side, single family home builders have actually done better than expected given how much mortgage rates have moved up. And the reason being is that during the pandemic and during the pandemic housing boom, builders had an insane level of pricing power, right? And so they really ran up. And what occurred is that their margins, profit margins, went to the highest levels ever. They were more profitable during the pandemic housing boom than they were in the run up of the housing bubble. And so once interest rates and mortgage rates shot up in 2022, builders, what they did is they waited a little bit, they cleared their backlog, they sold off some of the homes they had, and they moved, because what you don't want to do as a builder is you don't want to like cut price or give a huge much better incentives to communities that are already open, and then you risk your backlog, people getting out of backlog, because they're like, wait, you just cut their price X, Y, and Z amount, and I'm paying this, I'm out. So the builders took their time, and then into 2023, what they did at the end of 2022 into 2023 is they went and they met the market. So builders, some of them cut prices in some of these markets, but the biggest thing they did is affordability adjustments with mortgage rate buy downs. So if mortgage rates are 7%, maybe they buy you down to 6% or 5.5%. And what the builders did is they went out and found the market and continued to sell the volume. So on the new home side of the market, there's been a more of a affordability adjustment, but they've been able to keep volumes going. The existing side of the market has seen less of an affordability adjustment. A lot of prices are actually still moving up in some markets, but they don't have the volumes, right? They're not getting the volume side. And so I do classify this as a constrained market. It's a word that I made up, but it's a word that I think makes a little more sense to why you can see so many different things across the country, and where we kind of are right now with this. Some markets are still fairly tight on supply, and affordability is fairly deteriorated, at least from a recent historical perspective.
The Bitcoin Layer is sponsored by River. Make sure to check out river.com today, or the link below in the description. River is our preferred place to purchase Bitcoin. Now, when you're buying Bitcoin, guys, there are several considerations. Number one, should I be using an exchange? Is the exchange custodying their own Bitcoin? Is the exchange using platforms to custody that we don't know? Is the exchange leveraging its Bitcoin for other purposes? Well, with River, we know that River does not use leverage of any kind. River also uses its own multi-sig solution so that your Bitcoin are not held by anybody else. So it's a very important thing to understand about what River offers. Now, River also has Lightning Network integration and a lot of other really exciting features. Go check out river.com today. It can be easy to associate a great economy with the housing market, in that the economy is great, we should see the housing market do very well. But in reality, we have to look at the underlying fundamentals. And as you mentioned, there are fundamentals on the supply side coming primarily from mortgage rates, making them more unaffordable to people. And then you have still demand, even though it is falling, still outstripping demand and leading home prices higher on the aggregate.
So demand essentially had its trough in like January 2023, where it was a huge drop in demand from, like, let's say March or April 2022 to January 2023. At that point, it essentially stabilized, and it stabilized into a place also where inventory is fairly tight. And so a lot of these markets, that's why they saw the rebounds in prices, made up for the price declines that happened in the second half of 2022. And then some of the markets, in parts of Southern California or in the Northeast or the Midwest, actually went up and just set new all-time highs all of last year, and, still this spring.
Now, you have a chart here on the percentage of all cash buyers. It's hovering around 33% right now. It does appear to be trending higher over the last few years. What are your thoughts on this all cash market, and how is it affecting the housing market at large?
The percentage of all cash buyers is at about a decade high. It's about at the highest since it was like in 2012, 2013, which in 2012 and 2013, the reason that all cash was so high was there was a lot of investment pouring into the market, right? The Blackstones, a lot of the investors bought up the bottom of the housing crash, right? The reason that all cash today is higher is much different. The reason is that the market for overall existing home purchases is fallen fairly hard from where it was in 2022. Now, the number of all cash buyers has also fallen, but it hasn't fallen as fast as the other side of the market. And given that it hasn't pulled back as hard, is why all cash buyers now make up a higher percentage of the total pie that's remaining. Now, the reason for that is that with rates being so high, more sellers, when they sell their house to go buy something else, they're like, you know what? I'll just roll over the equity. I'm not going to deal with these 7% mortgage rates. So you're seeing more people, instead of taking out a mortgage, they're just like, you know what? I'll just buy the house all cash and I'll roll my equity over. So we're seeing more of that in the market. We're not seeing a huge jump up in investors. Actually, the institutional side of the market has fallen fairly hard from its pandemic highs and has rolled over because there's just less liquidity sloshing around in the economy these days, and rates are higher. So that's the reason for the increase in the all cash buyers. So there's a little more
Now,
to the story than the numbers.
of course. And Lance, I want to ask you about the Airbnb market, short-term rentals. We we are aware of over investment and potentially weakness in that sector. However, I'm sure that it depends on the region as well. So we have a chart here that shows housing inventory, active inventory in the largest 50 metros. We see a couple towns in Texas, San Antonio and Austin at the top there. Does this have anything to do with the short term rental market? Can you give us an explanation of where that market is and how it is affecting the housing market? And I'll just preface the question also, everyone's looking for the next bubble, Lance. Is there a bubble in Airbnb properties? And how is that
Well,
relating to
so
the
the way
housing
that
market
I
right
would
now?
talk about the short term rental market is in correction. There is a correction occurring. And so, what occurred at the onset of the pandemic is there was the lockdowns, right? And people weren't working in the office no longer, and they wanted space, and so there was an increase in demand for space, and there was also a lot of liquidity that came into the economy as well, right? So we saw a lot of demand increased for short-term rentals because people weren't in the office, they had more time to do it, and there was also a desire from the public to, for when they were going to put their vacation dollars to places, they wanted it to be to places where there was less people, right? They weren't doing cruises, right? Those were gone for a while. They weren't doing the international travel. They didn't want to be in packed hotels. So they were doing more of the short term rental travel. And then you had the work from home group, right? So the demand for short term rentals soared. The other thing that occurred is that interest rates and mortgage rates fell really hard, right? And home prices also started to rip. So there was a lot of people who had Airbnbs because there was a run up in demand that were making a lot of money, not just because their daily rates were going up, but also because home prices were soaring. And so the huge run up in the rates for Airbnbs because of all that demand, the very low interest rates, plus the run up in home prices, what that did is it was a green flag. Get out in the market, go buy an Airbnb. And so a lot of people ran into the market chasing the dollars, right? And they chased it. And so what then occurred is mortgage rates shot up in 2022. We had a pullback in the demand for Airbnb rentals because cruises came back, international travel came back, COVID was contained. And so that pullback in demand, plus all of the people going into the market and chasing it, what it occurred is demand fell, but then supply of the Airbnb rentals rose as all those Airbnbs people bought in 2021, 2022 started to enter the market. The supply increased and the demand fell. And so simple economics tells you when that occurs, there, the prices can fall, the occupancy rates can rise. And so we saw some of that in some of the markets. And some of the people who got into the Airbnbs, it didn't match their expectations, or that, and they're getting out. And so when I talk to real estate agents, even in some of these markets with very tight inventory, a lot of them talk about a good, there's a good number of sellers who are actually Airbnb hosts, or people who got into Airbnb during the pandemic and are now like, you know what, this doesn't meet my expectations, I'm out. So on a national level, it is out there. It's not enough to move the national numbers a lot, but on a regional pocket basis, it can play a role. And then the other thing that can happen is if you have a local municipality, like in Palm Springs, pass legislation which changes the economics for Airbnb rentals, right? And maybe you can't do it anymore, and so that's another headwind for the market. But in terms of like the overall market, or even on a metropolitan level, I don't know if it's playing a huge role. If we had a recession, maybe it could intensify. Uh, I think the big, it's definitely there, right? And it's played a itty bitty role in some sub pockets of Austin, sub pockets of Phoenix. It's something, but it's not like the real big thing.
Got it. So we should be watching local markets, Austin, Phoenix, and on
And
the
sub
aggregate, we
level,
should be
it's really sub markets within those markets for Airbnb.
got it. And we should be watching if we see the economy turn, how that can feed into some of the problems going on and the correction going on in short-term rentals. So we'll continue to watch that. You mentioned realtors. We recently had a large settlement about
Proposed
realtors and
settlement.
the
The proposed word is very important
pro-
because now it looks like the DOJ might
okay.
not sign off on it.
So explain to us what's going on with broker fees, real estate fees, and how you expect it to play out and how you expect it to impact the
Well, one
housing
thing I
market.
just want to be frank with is I don't exactly know how it's going to play out. And I actually think that a lot of people and a lot of the theories out there might not pan out either. But in a big picture, very high level, what has occurred is that across a lot of these developed countries, there are lower transaction costs for selling a home, right? For, buying and selling a home. In the US, it's around 5%. In a lot of these countries, it's 2, 3%, right? And so there has been a long-standing amount of political pressure because some groups and think that they view the National Association of Realtors as a cartel that's essentially helping to hold up these higher commissions. That's the argument. And so you have these lawsuits out there kind of feeding off of that. And it looks like the National Association, if this proposed settlement goes into play, they will now take the commissions off the MLS. And the groups that have been pushing for that believe that that will lead to some pricing adjustments on the commissions, right? It'll be more free market is their argument. Now, in reality, if there were to be a fall in commissions, which I'm not exactly sure if that'll actually play out, there's some counter arguments to that, but let's say net commissions fall. In the US, the group that pays commissions is the seller, right? They usually pay it for themselves and the buyer. And so if we see commissions fall, the person that would probably win there is the seller, right? Not the buyer. But we'll kind of have to see how it plays out. And, there's some theories that we could see more dual agency, where it's more the agent is representing the seller and the buyer. And we're going to have to kind of wait and see. But as of today, out in the real world, out in the real housing market, there has not been a huge pullback in the commissions yet. And if it were to start to occur and there were to be downward pressure, it could take many, many years to actually play out. And even if it does, it would most likely be the seller more so than the buyer that would benefit.
So let's get back to the market then itself. You mentioned repeatedly how high mortgage rates are impacting the movement of the market, the inventory of the market, the ability of people to get into a new house without putting down all cash or rolling their equity. So without making you forecast where rates are going, rates ratcheted higher today. We're at 7.33 on mortgage rates. That could trend towards 7.5 potentially here. How long do mortgage rates have to stay at 7.5% for the nationwide housing price to come down? So we saw Case-Shiller dip basically to a 0% year over year gain and has recovered very nicely. FHFA and Case-Shiller are both showing about 5-6% year over year gains in housing prices. So is this high mortgage rate going to keep the market frozen forever or not, Lance? How do you see that part of it
It's tough to say.
unfolding?
What we know on a local level is that where active listings, the inventory has gotten back to pre-pandemic levels, there's been more softness on prices and more give up on prices in a lot of those markets. So a lot of the markets back to pre-pandemic inventory levels have fallen 5, 10, 15%. A lot of these markets that, are still down 80% for inventory, they're actually 10% above price wise where they were in 2022. And then you kind of have some of these places in the middle, like the Phoenixes and or maybe not Phoenix is a great example, but let's say the Los Angeles, right, that are kind of like just a couple percent above where they were in 2022, but inventory still down like 30 something percent. But big picture, in terms of where prices are going to go, I think the way to look at it is on a very local level. And I do track this in my inventory tracker and my price tracker. I do think there's a possibility that some markets could fall more, right? If inventory gets up enough. But if inventory does not rise enough in these markets, it's harder to see a price give up. So I think that the active listings are the leading indicator here. Nationally, over the past 22 months or 21 months from Case-Shiller, nationally, prices are up about 1% from the 2022 peak over the past 21 months. And so the 21 months before that, prices went up 30%. So while we haven't seen a huge give up in prices, we have seen we've seen a pretty much a sideways movement that has helped to get the fundamentals a little closer in line. So when you say like prices are up 5-6% year over year, that's true, but from the peak it's still only up 1%. And the reason being is that prices fell about 5% in the second half of 2022. And although if you look on a year over year basis, it's only, essentially flat was the lowest reading for year over year. We did give a little bit of a give up, and then in 2023 on a national level was pretty much recouping that give up, which takes us to about 1% above the peak. So it's not sexy, but we have seen at least a deceleration from the very, very crazy frenzy during the pandemic.
What are some of the active listing numbers that you are watching most closely and give you some nervousness about those specific
Well, I
markets?
wouldn't describe my view as necessarily a nervousness about some markets, but because, the one thing is some give up. To one person, a little bit of price declines might be a bad thing, but to another person, it might be a good thing, right? Like it gets us a little closer to historical fundamentals. We were kind of in a very, very, very strained place, especially in the middle of 2022. But what I like to watch is active listings, and that is the active number of homes, both single family and condo, for sale in a given month. And the reason that number is so important is that think of it like a car dealership lot, right? If you don't necessarily need to have a lot of cars coming on to the lot to have it be a busy lot, right? If the number of cars start to sell slower, right? And the cars on the lot start to build up and they start storing them in other places and stuff like that, right? That full lot can start to suggest that, what, that car dealer might start doing some deals, right? And that's exactly how inventory works, active listings. It's essentially like the car dealership lot for your housing market. And it's everything for sale in a given month, not just what comes up for sale in that month, but also the things that didn't sell last month that roll over. And that's why it's a key thing to watch. And usually how price give up works in the housing market is active listings moves up, moves up, moves up, moves up, hits some type of critical mass, and then you see a bit of the give up in price. And the reason it takes so much to get a give up in price is that sellers are stubborn, right? They don't want to back off prices unless they have to, right? They have that number in their head and they're like, my house is worth X, Y, and Z. I saw my neighbor a year ago sell it for X, Y, and Z. I'm not selling unless I get X, Y, and Z. And so the only thing that forces them to actually bulk off of X, Y, and Z number in their head as they start saying, you know what, my house has been on the market for a really long time. A lot of these other homes in the neighborhood, they're up for sale and they're not selling. And I have these life circumstances. Maybe I lost my job. Maybe I need to move to another city and I can't hold out any longer and I have to sell. And as you start to see that process and marking down in prices, that's when you start to see prices move down. Most markets, they're not there, right? We're not even close to there because active listings are still so low. And, places like Hartford, Connecticut are down 80% for active listings. So that means for every 4 homes for sale in March 2019, there is now 1 home for sale in Hartford, Connecticut, from 4 to 1. That ratio is just a place where that market is just very tight still. And that's why they're up 10% year over year for prices. And they never even gave up for prices. And they're about 15 or 16% above the 2022 peak for home prices.
And very quickly, which are the markets that you're seeing active listings at a very high relative
San
level, I
Antonio,
guess,
New
to the rest of
Orleans,
the country?
Austin, parts of Mississippi, small parts like Jackson a little bit, some parts of Texas outside of San Antonio and outside of Austin are really far away from Dallas, like really, really deep exurbs, not in the like prime suburbs of Dallas. Dallas is actually held fairly firm in Austin, not Austin, but Houston is actually held fairly firm too. Inventory still tighter there. Southwest Florida has seen more of a run up in inventory, especially the places like Cape Coral that were hit by Hurricane Ian in September 2022. And they have a little bit of that inventory of damaged properties from the hurricane that's kind of sitting on the market and putting downward pressure. Otherwise, outside of pockets of Alabama, some pockets of Louisiana, Mississippi, Florida, and Texas, there isn't a huge run up in active listings in the country. Now, those markets are doing enough to help to move up the national numbers. Nationally, we're up about 25% for active listings year over year, although we're still down about 37% for active listings in March 2024 versus March 2019. And that's really the main primary reason that we haven't seen more of a price softening.
Got it. So even though we have an uptick, we are still over 30% lower in nationwide active listings versus 5 years ago. Lance, I'm wondering if you have an opinion on labor market dynamics. What
Oh,
I
I
mean by
wish, I
that,
wish, because that would help me to understand where the housing market would go. That's the other side that I kind of rely on other people. Maybe I rely on people like you or other economists or analysts. It's the tricky side, right? Because if the labor market would soften or soften fairly quickly, or maybe not soften because it has softened from the pandemic highs, right? Although unemployment hasn't ran up, you have seen a softening. There's fewer jobs available. It's harder for people to find new jobs when they lose a job. But if we were to actually see layoffs move up much harder, or we were to see weekly jobless claims move up much harder, or we were to see the unemployment rate to move up much quicker, what we would see in the housing market is we would see an improvement in affordability if mortgage rates and the bond market, and if the yields were to fall. Um, that would improve affordability, and you could see more churn in the market. Now, the other side of it is, depending on how it all plays out, if just because mortgage rates fall doesn't necessarily mean it'd be a great thing for the housing market if the job, depending on where the job market actually gets to, right? And what type of distress selling you could see in housing in the situation where you did see a harder landing. I don't know if that's where we're headed. Maybe we achieve this all, this talked about soft landing. That would be great. People would love that. But if we didn't go there, housing could go a few different ways depending on how it broke, how the situation actually unrolled, and how fast things occurred would impact housing as well. Housing, these markets, while they're down in active listings, you can actually go from where these markets are all the way back up to pre pandemic levels in a 3 month period if demand pulls back hard enough. So Austin went from a place where they were down, like a Hartford, Connecticut, like 80% from pre pandemic levels, right? There was like 3,000 active listings in Austin. Within just 3 or 4 months in 2022, they went from 3,000 active listings almost to 12,000 active listings. And it wasn't because a ton of people sold, it was just demand pulled back so hard that everything on the market, like a traffic jam, just stayed on there and didn't exit. And it just kind of got cramped up. So I don't know how it'll play out on the labor market side. And depending on how it plays out, if there were to be a downside to it, housing could go a few different directions. And, maybe it's the more bearish side, but then there's also the fact that if affordability were to improve, just because you see more new listings of people selling because they're like, okay, I can finally afford to sell. When they sell, they are supply because they're selling, but they're also demand because they're buying, the locked in people. And then you also have the marginal demand on the outside where it's like rates fall and now I can afford to buy can come into the market as well. So that the question that you asked of where the labor market is and where it's heading, and if it were to go into a worse place, how that would impact housing, that's actually the hardest question that you could ask me. And I don't have a great answer because it could go a few different directions.
Sure. And I would even ask you to go one step further and step out of your own shoes into more of an economist's mindset for a second and give us your opinion. This doesn't have to be an analytical take, but just give me your opinion on how the US labor market has changed through your eyes. My question comes from this idea, we're not sure if we believe it or not, that claims are low, meaning the unemployment claims that get released every Thursday morning by the Bureau of Labor and Statistics that you mentioned, that claims are low artificially because the person who's getting fired or leaving their
And
job
severance.
goes to not even severance, but goes to Uber or DoorDash
Mm.
and doesn't file the claim. And that we have an increased gig economy at large, which skews aggregate labor statistics and doesn't give us a great read because we are more in a gig economy.
Yeah. Well,
Does that
so
register with
let's
you?
kind of play with that thought of yours. If that's the case, what it could mean is we have a more efficient market, right? Where the supply of labor can meet a demand in the economy in a way that it couldn't in previous generations, right? Because maybe somebody lost a job in previous generations and they're like, I can't make any money anywhere else. And it hits them harder. And so they have to pull back on their spending harder, which hits the economy harder. So maybe you're right. But if you are right with that or that idea, that concept, it could also be in a place where it helps to hold the economy a little firmer than otherwise expected because it's more efficient and they don't have to have a harder pullback in their personal demand. I don't know if that's the case. I don't have great data on it, and I'm one of those people that if I don't have data on it, I don't like to have too much of an opinion on it because I want to be like very data driven with my work. So I don't exactly know, but it is an interesting question that I would love to see economists and researchers smarter than myself dig into and
Sure.
get some good data on.
And Lance, so that you're familiar at the Bitcoin layer, we are extremely data driven. We never shy away from offering our opinions, but we're more the type that asks the question and then tries to flesh it out over the next
Yeah,
several
I love
months
that
or even
approach.
years. And we appreciate your honesty, but also just thinking it out loud with us because that's really what we're here to do. If we don't have a number, the number that we have is aggregate GDP. The number that we have is, unemployment claims, active and continuing employment claims. And then we have numbers themselves on the housing market showing us that home prices are essentially at all-time highs here in this country. And that must be supported by economic strength one way or the other, whether it's from liquidity, the labor market, we're not sure. So, we're also trying to piece all these things
Well, yeah,
together.
and we were in an unprecedented economy where during the pandemic there was so much, very very low rates, right? A tremendous amount of stimulus, and then even stimulus that came after the economy was starting to recover. all into the economy. And then the job market overheated, right? And so even now, some companies are a little afraid to lay off employees because they were just in a place not too long ago where they were really struggling to find them, right? And quits rates were very high. And then we were also in a place where the housing market got very, very overheated. And the housing market in particular is one of those places where when prices overheat, it's very hard to get them to give up, right? It takes a lot to get prices really rolling over. The economy has just went through a lot of really unprecedented events over the past, 3, 4 years. And it's crazy to think of, but last year or last month, March 2024 was actually exactly 4 years since the onset of the lockdowns.
Now, Lance, I have on the screen here for the audience an ad from a Sears catalog about a century ago of a house for $1,945. You wrote about this. Give us the background. What is this story, and how does it relate today to Home Depot selling tiny homes for $63,000?
Yeah, so way back in the day, Sears Roebuck, back in the catalog days, so this predates World War II. You could order in a catalog from Sears a home, and they would deliver all the parts. Everything would come to you, and then you would put it together, right? Or you would have somebody, a local crew, or somebody help you put it together. And they sold 70,000 homes this way. And that has since gone away. It's been away for a long time. But over the past decade, with housing affordability getting so strained and prices running up so much and inventory being so tight, one thing we've seen more of is a push for more tiny homes and a push for more ADUs. So putting smaller homes onto existing properties. And Home Depot has rolled out a few different tiny homes that you can go on their site, these ADUs/tiny homes, order them. They'll come to you, and they can come within 3 or 4 weeks, deliver all the parts, and then you put together this tiny home or ADU. Now, how feasible is that, and how much will that move the needle? I don't know. Some communities don't even allow these properties. The zoning is very different across the country, and even down to a municipality level. But big picture, what it says, this housing market is very strained, right? Affordability wise, inventory wise, in a lot of these markets. And so, builders and companies, even like Home Depot, there's more of an emphasis on doing things like this that are untraditional and creating more of these smaller homes. And by the way, even a lot of the big box builders, they're cutting down on square footage size, right? They're going smaller. There's like some shrinkflation in the economy right now in housing because affordability is so strained that buyers have almost no choice. Some of them to shifting their expectations at least.
Lance, what are the pockets of the country that you believe will benefit from dynamics such as this, as well as dynamics of people leaving areas that don't have the inventory and just don't have the physical affordability? This is the California to Texas and California
Yep.
to Arizona move that we saw over the last 5 years. It has slowed, as you mentioned, but what's the next move? You could even go 10 years out. Where are the pockets of the country that you feel will receive net people?
Yeah, I think one place that could benefit from this strained affordability, and the word benefit, by the way, is subjective, right? Because we could look out from a lens and be like, oh, more people go there, they're benefiting. To locals, more people coming, affordability straining, all those issues, they might not view it that way. But I would say a lot of these Midwestern markets, right, or a lot of like some of these like parts throughout the Southeast that aren't necessarily Charleston, aren't Atlanta, Tampa, the bigger parts that have gotten more growth. Maybe some of those submarkets or some of the secondary cities in the Southeast too, where affordability is still a little better. So I think the places where affordability is less strained, Columbus, Ohio, Indianapolis and Indiana, Louisville, Lexington, Cincinnati, Pittsburgh, uh, Milwaukee, Grand Rapids. I think some of those cities, maybe Memphis. I don't know. some of those places could benefit more, given how much affordability is strained at the moment.
This next chart, it's a lot of red. It's a heat map. We're looking at multifamily vacancies across the country. 10% in Austin leading the way. Austin keeps coming up here in terms of one of the weakest housing markets. What are the takeaways here from multifamily vacancies? And what are your thoughts on multifamily in general, in terms of apartments versus buying and how that's affecting the housing market?
Yeah. So the multifamily side of the market has a good amount of supply, especially in these Sunbelt markets, that's coming online. It started last year. It's coming more online this year, some of it into next year. What occurred is that during the period of very, very low interest rates, there was a lot of capital that went to multifamily projects. Well, building an apartment building isn't fast. It takes a long time, and sometimes it takes years from the development phase, the funding phase, all the way to the end completion phase. And so we are getting a little closer to the end completion phase for some of these multifamilies that were, done in like 2020, 2021, early 2022. And that increase in supply is cooling the apartment markets in places like Austin, places like Nashville, as that multifamily supply hits the market. Some of those markets are seeing outright declines for apartment rents, and some of that will continue through this year. But then there are other parts of the country that aren't seeing as much multifamily supply, or there's also rental markets that are single family and don't have the multifamily supply and have stayed fairly tight. And the rents for single family in the country are still up 4% year over year, right? Multi's up closer to 2.5%, with some markets seeing outright declines. And so, if you ask for my view of the housing market on the rent side, it is that single family has stayed stronger, more resilient. Multifamily and some of the cities that has less construction has been a little more firm. Everything is decelerated, right? Nothing is going up for rents like it was in 2021, but some growth still. And then where you've seen the most give up for multifamily rents has been in the places that have the multifamily supply, the boom towns throughout the Sun Belt, Austin, Nashville, where you've seen more give up.
Lance Lambert, co-founder of Resi Club. We appreciate your insight. Thank you for sharing your expertise on the housing market. Please tell the audience where they can find your excellent work.
Yeah, so about 5 or 6 months ago, I left Fortune magazine, where I was the real estate editor for about 4 years. And before that, I had worked at Realtor.com and places like Bloomberg. I left to build this publication called Resi Club. And I really view it as people's like data-driven gateway to the US housing market. I do 5 free newsletter issues a week, 5 free articles in front of the paywall for audience. I also do 3 additional research articles per week. And I have my own housing inventory tracker where I track 800 metros, 3,000 counties across the US. I give a lot of zip code data as well. And I have that for inventory and for prices. So if you want to find out prices, historic or recent, for any county, any metro in the country, you can get it in the tracker for inventory, for prices, days on market, new listings, active listings, all that stuff. And in order to sign up for the Resi Club newsletter, you can go to ResiClubAnalytics.com. Just put in your email. You'll be signed up for the free newsletter 5 days a week. There you can also find access to the premium if you want to upgrade. And if you want to follow me on Twitter, you can find me at NewsLambert, at NewsLambert. And again, the website is ResiClubAnalytics.com.
Thanks, Lance. And we'll make sure to include those links. And we hope to have you back on the Bitcoin layer so we can keep ourselves updated on the U.S. residential housing market. Lance Lambert, thank you for joining us. I'm Nick Bhatia. We'll catch you guys next time.
Anytime. Thank you.
Special thanks to River for sponsoring this channel. Purchase Bitcoin without any fees when you use River's DCA feature. River has become our trusted source of accessing the Bitcoin market because they don't use any third-party custodians. This is a very, very important thing to understand. River is not using another company to store the Bitcoin for them. They have their own multi-signature solutions, which means that they have designed their own way to make sure nobody else has responsibility for the Bitcoin for the time that you have River hold your Bitcoin for you on their platform once you have purchased it. So go check out river.com today. Thanks for sticking with us. As always, at The Bitcoin Layer, subscribe to our channel. Subscribe to our Substack at thebitcoinlayer.substack.com so that you can follow along our latest research and analysis.